Hello, everyone. Happy New Year. On today's live video, we are going to be discussing Secure Act 2.0 and its impact on self-directed IRA accounts. And this is a monumental piece of legislation. It was stuck into the $1.7 trillion omnibus bill that President Biden signed right before New Year's. Actually, I read somewhere, I'm not sure if it's true, but I read this, that the bill was actually flown to St. Croix. That's where President Biden was vacationing. So it took a private jet there because they couldn't get it done before he left. But anyways, this is a really important piece of retirement legislation, probably the most important since 2019. So I'm happy so many of you are watching, because it is super important. There are some really cool provisions in here. And on today's video, I'm just gonna talk about the provisions impacting self-directed IRAs. Maybe next week I'll do provisions impacting 401ks and solo 401ks. But on today's live video, I wanted to just do self-directed IRAs. And there's a significant amount of provisions that address IRAs, Roth, SEP, simples, some even prohibited transactions, statute of limitations. Yeah, there's some cool stuff in here. Overall, my thoughts, it's a winner. I'd give this kind of an A. There are some provisions which I'll mention that I wish were included, but overall, I give Democrats, Republicans, an A. They did a fabulous job. They worked together. See what happens when folks in Washington work together? Good stuff happens. Yes, I know retirement accounts is not as politically divisive as gun rights or abortion or all kinds of other stuff that we like to fight about. But it's nice to see that the folks on the Ways and Means Committee, the Senate Finance Committee, all did a really good job, worked really hard to get this done. This is a monster bill. So the Secure Act 2.0 is part, as I mentioned, this Omnibus Act that was really needed to keep the government running. So that's why President Biden had to sign it on vacation. There's 4,000 or so pages. It's a monster. There's close to 400 pages involving retirement accounts. And I went through it. I got some help from some colleagues, some team members, but I went through each provision. And I summarized each provision, and I've done a blog on it. I'm going to do another blog that's focused just on IRAs and another on 401k. So some people rather read it than watch me or listen to me, which is totally cool. I got that. So I will do that for all of you. But for the next 20 minutes or so, kind of stay with me. I'm going to try not to go too much in the weeds. I'm going to try to just focus on the key points of each of these provisions. But some of them are gonna change the way we strategize for retirement. Some will change the way we determine which type of retirement accounts we're going to use. So it's some pretty big stuff here. Let's just start. I didn't put the summary in terms of rating them like 1 to 20 in terms of what I thought were the most important. I'll do that at the end. I basically went through the act, the bill, and kind of just went one by one and just wanted to focus on the ones that were relevant impacting IRAs. Although kind of cheated because the first provision is Section 107, which is not the first provision involving IRAs, but I wanted to put it out there because it's the most important one. This bill increased the required minimum distribution age from 72 to 73, and that starts on January 1. Okay, 2023. So basically, if you turn 72 in January this year, you don't have to take an RMD till next year. Whereas if this provision was not in the omnibus bill, you would have to start taking RMDs this year. Well, you would have to make your first RMD distribution by April 1st, 2024, but you'd be in the RMD world because the RMD age prior to this provision was 72. They increased it to 73, and ultimately it's going to go to 75 starting in January 1, 2033. So we'll stay at 73, and it's going to go all the way to 75 over the next 10 years. Good, right? The longer money's in a retirement plan, the more money will have to grow without tax, more opportunity for tax deferral. We're also living longer, which is great. So finally, the IRS realized that, hey, they went from 70.5 to 72 in 2019, which began in 2020. Now they're going to 73 beginning in 2023, and then ultimately to 75 in 2033. So I cheated. I wanted to talk about that first because that impacts people right away, right? Starting January 1. If you're born on January 1 and you turn 72, you have an extra year to worry about RMDs. Okay, so now let's go all the way back to section 103. And this one's not super vital to a lot of you, but I'm just going to mention it. It's the savers match. And basically under current law, you have non-refundable credit for certain individuals, low income earners. And what they're going to do now is instead of giving you a credit, they're going to allow you to match 50% up to $2,000 per individual into a Roth IRA. Okay, so credits have value, but if you don't pay a lot of tax, a credit reduces your taxable income dollar for dollar. But if you're not paying a lot of tax, right, the credit just doesn't have that much value to you. But giving you $2,000 of free money in a retirement account, that's value, right? Because now those funds can grow without tax. You can hopefully preserve it, keep it in the IRA, and take it out later on. And that $2,000 over the next several years adds up, compounds, and you can have a good amount of money down the road, all thanks to the government giving you free money. So it phases out at $71,000 if you're married, filed jointly, $35,000 if you're a single taxpayer, and if you're filing separate, $53,000. So again, it's for low mid-income families, but I think it's a great provision. This starts only in 2027, though. Okay, so it doesn't start right away. Why? Because it's going to cost the government some money. So they're like, let's kick it down the road 4 more years to the next administration. They can deal with this, but it's in the books. So the next administration is going to have to deal with it. But the Democrats can always say, hey, we did it. But the Republicans or whoever is in office in 4 years are going to have to figure out a way to pay for it. So they're basically giving $2,000 of free money, but not free money so you can go to Gucci and buy a pair of shoes or a purse, but free money in an IRA, which I like. I actually like this idea. It shouldn't cause inflation because people aren't just going to go out and blow it. It's going to be in a retirement account, probably locked up, maybe potentially also forced into certain more moderate, safer investments, and help those folks that generally don't have IRAs save. So I'm in favor for it. I like it. Section 108, indexing IRA catch-up. So right now, what's a catch-up? That means when you're over 50, you can put away more money in your IRA. The IRA catch-up contributions, for some reason, are not indexed for inflation. 401k catch-ups are. That's why there's a much bigger spread, right? $7,500. In 2023, it's $22,500 or $30,000 if you're over 50. The IRA is $6,500 or $7,500 if you're over 50. Very small spread. Why? Hasn't been indexed for inflation. Don't ask me why. Makes no sense. Fix that. Now it will be. So now you're going to see a larger spread in the coming years. I don't know how large because we don't know how bad inflation is going to be, but it will be a bigger spread, which is nice, right? Why? When you're over 50, hopefully you're in prime earning years and you can put away more in an IRA, which again will allow more money to grow without tax, take advantage of deferral, compounding returns. You have more money at the end of the day. Everyone's happy, right? The government should be happy because hopefully you'll be less of a burden on the government. You'll be happier because you're not going to have to rely on Social Security. You have more money to take nice vacations, help your kids out, buy a nice vacation home, whatever. It gives you more security and hopefully less anxiety and more comfort as you're older. Okay, next one. This is another biggie. Section 109. Higher catch-up limits to ages 60, 61, 62, and 63. Okay, so basically they're saying once you hit 60, 61, 62, and 63, we're going to give you even a bigger catch-up. Okay, assuming right now we're talking about 1,000 catch-up, right? That catch-up will go up. We're going to have inflation. The spread will go higher. They're saying at age 60, 61, 62, 63, we're going to basically allow you to go higher than that. We're going to let you go to $10,000 or 50% more than the catch-up amount in 25, right? They don't know what the catch-up number in 25 is. That's why they didn't just say 10,000 bucks, because maybe it'll be higher, right? If we have runaway inflation for the next few years, if the feds can't control inflation, then maybe the catch-up will be 11 or 12,000 bucks. So in order to still have value to this provision, they said, okay, $10,000 or 50% of what the catch-up amount is in 25. Okay, 50% more, I should say. So if the catch-up amount is 8, they'll let you go to 12. Okay, so again, another provision. This is only for those 4 years, 60, 61, 62, and 63. They're going to let you catch up. Good stuff. Why? Because the idea is that, hey, let's give you like 4 more years to kind of push as much money as you can into a retirement account. Good provision, right? It'd be nice to just extend it. Why not just make it 10,000 bucks over 50? Or just force you to do Roth, right? So this way you're not reducing taxable income, because that's the issue government's having right now. There are 2 themes to this bill. You're not going to see as much in the IRA, but trust me on this. The 2 themes are in the 401k. They want to push auto enrollment. Studies show clearly that if you auto enroll people into a 401k, they're just going to save by habit. They're not even going to know they're saving. The money's just going to come out of their paycheck. And down the road, they're going to be happier they did it. It's much harder. Less people will just proactively opt out. Once they're in, they're in. It's very hard for them to kind of just jump out. So that's good, right? And then the second theme is Rothification. Government is very pro-Roth. And I've talked about this many times. It doesn't make sense, right? In 10, 15, 20, 30 years, all of us are going to be able to pull money out without tax in a Roth, because we'll be over 59 and a half, and the Roth will be open at least 5 years. Doesn't make sense. But if you're a government today, if you're in an office today, what Roths do is they don't reduce taxable income, right? It's after tax. Pre-tax IRAs reduce your taxable income because they generate deductions. Deductions are not very favorable for current administration. Why? Because it reduces taxable income, less money to play with, right? Less money to special interest projects, schools, military, roads, all the stuff they're supposed to be doing, plus other stuff. So those are the 2 themes. So what I would have done, I like this provision, but I would have expanded it to be like, okay, from 60 to 75, you can go up to 15,000, but it has to be in a Roth, right? Here, they're giving you a chunk, a bigger chunk, but it's only for 4 years. And for the simple IRA, they've played around. Instead of 10,000, it's 6,500. Okay. Next provision. They're going to play around with the simple IRAs. There's a couple provisions here. They're trying to make the simple IRA provision more popular, the simple IRA plan. Simple IRA, call it a poor man's 401k. 401k, you can put in 22,500 or 30,000. Simple's 15,500 or a $3,500 catch up. There's no loan feature. So just, it's not as good as a 401k. The advantage is the custodian, IRA Financial, for example, does all your administration, your annual filings with the IRS, whereas in a 401k, you have to file the 5,500s. So basically what they want to do in this provision is they want to make employer contributions. They want to give you a chance to make larger employer contributions, and are going to index the catch up. Okay, so a good, nice little provision to basically expand the popularity of the simple. Another provision that I want to talk about is SEPs. What they want to do is basically, this is a funny one. I have to include this. They basically want to say, listen, if you have a SEP, okay, you can include your domestic employees, your nannies, as employees. This is a weird one. Okay, this is effective now. 23. This is one of the weird ones, which is like, who pushed for this? I'm dying to know, like, who in Congress or Senate pushed for this thing. It makes not a lot of sense, but I wanted to include it. Just like, how many people want to include their nannies in their SEP? But hey, I guess there's enough of them. Okay, the next one is a cool one. This was not in any House version or Senate version. A lot of these provisions we've seen before, and I've talked about them because they're in various versions of the Secure Act 2.0, which has been floating around Congress and the Senate for the last, I don't know, 8 to 10 months. This is a new one. And basically it says this: if you got excess money in your 529, and a 529 is, we all know what that is. It's a long-term qualified tuition program, right? You put money in there. It's after tax, but the money grows in the plan without tax, and you use that to pay for school for your kids or grandkids or family members, whoever it is, right? And there's limits you can put in. But what happens is there's sometimes money left over, right? Rare, right? Cost of tuition, but hey, I guess it could happen, right? Maybe the kids don't go to school, right? They do a year and they say school's not for them and they move on. This provision is going to let you go up to $35,000 and pull that money out of the 529 into a Roth IRA. Now you're going to be limited to the Roth IRA limits for that year. And there's the money has to be in the plan for, I believe, 15 years, but they're going to let you up to $35,000. You'll permit to be rolled over to a Roth IRA, but it has to be open for at least 15 years. Okay, so another encouragement to have people save in a 529. This way you don't have to worry that if money left over, it's going to be stuck in there, you're going to lose it or give it to someone else. No, you can just roll it into a Roth, which is helpful, so the money can continue to grow without tax. Next one, section 302, which is it's a really important provision. So basically now, if you screw up your RMDs, if you don't take enough, you fail to take it, there's a 50% excise tax, which is a grave penalty. You know, who's doing RMDs, right? It's older folks. The rules are complicated. People forget. They go on vacation. They get sick. Things happen, right? You're not just as swift as you were in your 50s. Okay, I've seen it, family. You screw up, you miss it, right? The year kind of just comes at you too fast. You forget to take the RMD. 50% excise tax means, let's say you have to take $2,000, you have to pay $1,000 tax. That's a lot, right? You're stealing money from folks that need it. So they're saying, okay, we're going to reduce it to 25. And if you fix the problem quickly, we'll reduce the excise penalty to 10. Okay, so a nice little provision. They understand they want to punish folks that are retired. Generally, you're over 72, now 73. You're probably on fixed income. You need the money. They have to punish you somewhat because if not, no one would ever take RMDs, but they don't want to make it excessive. So a good provision. Okay, next thing I wanted to talk about is safe harbor IRAs. This is in section 304. Believe it or not, there's billions of dollars stuck in retirement plans, 401k plans, of folks that kind of you worked at company X, company Y. Maybe you left after a year, 2 years, 5 years, 10 years, 6 months, and they auto-enrolled you in a 401k. You didn't even know about it. They pulled money out of your paycheck. You didn't even realize because it was a small amount. You figured it was tax. Maybe it was $20 a pay period, $10 a pay period. And after 2 or 5 or 7 years, it's thousands of dollars. And you leave your employer and they don't know what to do, right? You didn't tell them to roll it over. Why? Because you didn't know it existed. So that's called a safe harbor IRA. And what that means is now your 401k administrator could send it to an IRA custodian, and they've increased that limit from 5,000 to 7,000. So they're going to allow more of this to go to an IRA custodian, which is supposed to look for you. Sometimes they find you, sometimes they don't. I'm not sure how hard they look for you because what's going on, right? The IRA custodian that has the safe harbor IRA is just taking fees out of it. But nevertheless, they do serve an important purpose because that money is yours and it needs to go somewhere. The 401k administrator doesn't want the responsibility of dealing with it. So they ship it off. And what they're also including is a lost and found. Basically a database that will take effect in the next several years where you'll be able to type in, no one's really sure what, maybe your name, social, last 4 digits, something. And you'll be able to see if there's any money left behind, right? You work, let's say FedEx, UPS, Apple, whatever, and you realize that, holy crap, I have $2,000 or $6,000 or $8,000 left. I can see it. Now the problem is, right, companies merge, they go bankrupt, there's issues, and you just lose track of the money. And someone worked there 3 years, they left on bad terms, they go to another company, they never realized they had a plan, that prior company merges, but the money's still there, right? The company is merged, but the 401k is still intact. It's still there, your money as the participant. So that money goes into a safe harbor IRA, but in a lot of cases, it just never ends up in the participant's hands and it gets wasted in fees. So they're going to try these provisions are there to try to make that problem go away, which again, a commendable approach, and I like that. Next one is a pretty big one, Section 313. This is a big provision with a lot of meat in it, and we'll see what it means, because there could be some potential implications for other IRA transactions. So Section 313 is basically if you did an excess contribution, okay, let's say instead of putting in $6,500 this year, you put $8,500 in, right? You have $2,000 of excess contributions. There's an excise tax on it. But no one knew when the statute of limitation ran, because some people do excess contributions. They don't even know they did it, right? So technically, people believe that the statute of limitations, which was generally 3 years, would run when you file 5329, which is the excise tax return. But no one filed it because they didn't know they did it. So what they did in this provision is they said, okay, we're going to give you a 3-year statute of limitation, but it starts when you file your 1040, which everyone files a 1040, so that's good. Okay, but we're going to extend the 3 years to 6 years. Okay, so if generally Section 313 says, hey, there's a 3-year period of statute of limitation when you file your return. Okay, except in the case of excess contribution. So if you're generally other than excess contributions, it's 3 years. But we're going to make it 6 for excess contributions because we don't know when people are doing it. And a lot of times the folks don't know they're doing it because no one's filing the 5329. So to give the IRS a chance to catch you, we're going to extend this to 6 years, but only for excess contributions. Okay. And there's a further exception from the 6-year rule for taxes that arise out of bargain sales. So the bargain sales seems to only have a 3-year rule. It's a little bit unclear. So basically this, if you do an excess contribution, it's basically going to be a statute of limitations of 3 years when you file the 1040. But for the excess contribution, the period of statute of limitations is 6 years. So they'll have 3 years when you file your return to go after excise tax, but they can go after your excess contribution for up to 6 years. Okay. So it's a little bit confusing. You know, is it 3 years or 6? When does it apply? Bargain sales seems to be back in 3, not 6. I wish they would have drafted this provision clearer. My concern is they maybe did it on purpose to give them broader scope and when they apply the 6-year statute. Because obviously the IRS likes a 6-year statute, gives them a lot more time to catch you versus a 3-year. So they're saying, hey, we're going to give you a 3-year when you file your 1040 for the year of the violation. But for excess contributions, it's going to be 6 years. But for the excise tax, it's going to be 3 years. You know, a little bit unclear. Just say 3 or 6. They're saying for the excise tax on the contributions, it's 3, but to go after your excess contributions, it's 6. But bargain sales don't apply the 6-year rule. Again, I'm a little bit concerned, and I've talked to some folks, some other tax attorneys about this, and they're also a little bit concerned because it seems like they could potentially use this and try to argue 6 years and try to argue certain transactions are excess contributions, and we're going to go after 6 years. And here they're saying, well, the excise tax is only 3 years, but for an excess contribution transaction, we're still got the 6 year. A little bit quirky, a little bit wonky, but I think they did that on purpose. So we'll talk more about that as there's more guidance on that from the IRS and there's more chatter about the impact of 313. This is a cool one on prohibited transactions, Section 322. Basically, prior to this provision, it was understood, but there was no guidance. Is that, let's say you had IRA A at IRA Financial, and you had IRA B at Custodian XYZ, and IRA B, Custodian XYZ does a prohibited transaction. Could the IRS go after IRA. The answer was always no, but now they made it clear, no, you can't do it. What we were hoping for, and I was personally hoping for, and I thought this was going to be in there, was the following. I thought it was going to say that if your IRA does a privileged transaction, let's say IRA had stocks, cryptos, and real estate in the IRA, and the real estate, you did a privileged transaction. You screwed up. Obviously, you didn't watch my videos or listen to my podcasts or read my blogs or talk to us. You screwed up. You were on a deserted island and you screwed up. What I was hoping for is they'd say, okay, that transaction is isolated and it's not going to impact your stocks or crypto investments. That's not what 322 says. 322 says that an individual multiple IRAs, only the IRA, not the investment in the IRA, but only the IRA with respect to which the privileged transaction occurred will be disqualified. So basically what you need to do is isolate transactions. If you think you're going to do something grayish, obviously if it's privileged, do not do it, right? If you call me and say, Adam, I want to buy a house and live in it, I'm going to tell you, no, do not do it. But let's say there's a gray area, right? Let's say you're investing in a business, you own under 50%, but you have some involvement. Let's say it's a gray area, right? Probably 95% it's not prohibited, but maybe 5% you get a crazy IRS agent who wants to make a point and tries to argue privileged transaction. Basically, 322 is saying, okay, just set up multiple IRAs, even in the same institution. So have 3 IRAs at IRA Financial, and just isolate the one that's risky, or just isolate all your transactions. Okay. Yeah, maybe there's a cost. Maybe call us and say, hey, work out a deal with us. I'm only doing this IRA to isolate my transaction. It's still really the same IRA, but I need some help. We'll work with you guys. Don't worry. But that's what's going on. Obviously, 99% of you are not doing transactions that have any bit of privileged transaction risk. But if you're in that gray area, what you need to do is isolate that transaction. Because now 322 clearly says if IRA A screws up, then IRA B, C, and D are safe. So that is effective starting January this year. Also, the IRS finally said that, hey, we're gonna figure out this rollover thing, right? It's such a pain in the butt. Rollovers from 401ks to IRAs, IRAs to 401ks. There's different paperwork. There's no set paperwork. Some institutions want original signatures. Some want faxes. Some want email. Some want FedEx. We're going to make everything standardized, simplified. The problem is that the forms must be completed no later than January 2025. So they're giving them 2 years to do it. It's going to be a miracle if they accomplish it by then. But at least they understand that the rollover process is quirky, messy, and needs to be fixed. There's $500 billion of rollovers each year, and they need to fix it. So the good news is they understand that, and that's good. Okay, what else did I want to talk about? Okay, this is a biggie. SEP and simple IRA contributions, okay, have always been pre-tax. Right? You make a SEP contribution, which is a profit sharing contribution, or a simple IRA contribution, which is done as an employee and an employer match. It's always been pre-tax. Going to my Rothification theme, section 601 says, guess what? You can now do Roth SEPs and simples. And that is effective beginning today, January 1, 23. So this is a monster. And I left it at the end to make sure you guys are still awake. Starting now, you can do Roth contributions for SEPs and simples in 2023. You've never been able to do that before, ever. Since 1974, when IRAs, SEPs, simples were created, they always had to be pre-tax. Roth came into existence in 1997, which was a monumental step for the progression of IRAs. We're living in a monumental day and age as well, where SEPs and simples can now be made in Roth on a Roth basis. Okay, so this is breaking news. And I'll go through at the end and kind of summarize the most important ones. This is a monster one. This is up there with RMDs changing, indexing IRAs, catch-ups, and also the 60, 61, 62, 63 increased contribution. This is a monster. So being able to do Roths and a SEP and Simple could add some more popularity to SEPs and Simples, which is, again, important. That's what folks in Washington want. They want more people to save for retirement. Why? Because it works. It's based off simple mathematics. The more money you put away that in a retirement account, IRA or 401k, whether it's tax deferral or tax-free, it's going to grow because there's no tax. And compounding returns, your money should double every 8 years, assuming an 8% rate of return. That's basic Albert Einstein mathematics that coined compounding returns, the eighth wonder of the world. So IRS understands this. Members of Congress, senators understand this, and they're trying to rig the system in our favor. They're helping us. They are actually on our side. Why? Because they're also citizens, they're also taxpayers, and they want us all, including themselves, to have more money in their retirement accounts. So two more I want to talk about. Again, against the theme of making it easier to have a retirement plan. If you have a simple IRA and you want to move to a 401k, you're going to be able to do that mid-year. You used to be able to have to wait till the year's up. That's going to start in 2024. And then the last one, there was some confusion that if you basically, if you had to take a distribution because you over contributed to an IRA, there's an excise tax on that. But the question is there also a 10% additional tax on the distribution? And the answer is no. There's no 10% tax on top of any excise tax. So there's no double tax. If you make an excess contribution, you correct it. Maybe there's an excess tax, but there's no 10% additional tax on early distribution. Correct it. Maybe there's an excess tax, but there's no 10% additional tax on early distribution. So they're not treating that as like an early distribution. They're letting you correct it. Maybe you have to pay an excess tax, but you don't have to pay, in addition to that, a 10% early distribution penalty. So in sum, those are the, 20 or so key self-directed IRA provisions. Let me rank them now. Let me have some fun ranking them. So number one, I'm going to go RMDs because that's going to hit people today. Expansion RMDs from 72 to 73, ultimately to 75 in 2033. My next one is I'm going to go with index of IRA catch-up limits because as people get older, over 50, moving that $1,000 to potentially $6,000, $7,000, $8,000 is a game changer, right? Imagine you turn 50 and the catch-up's not 1,000, but now it's 8,000 or 9,000. And imagine you do catch-up for the next 20 years. It's an extra $160,000, $170,000, $180,000 of excess contributions you can now make. Even if it's Roth, who cares? And that money now is going to grow without tax. So from a dollar standpoint, indexing the IRA catch-up contributions is probably the most important one in this whole bill. Third, I'm going with higher catch-up limits for 60, 61, 62, and 63. I like that one a lot. That would be my next one. After that is the Rothification of SEPs and Simples. You don't have to do Roth, but you now have the option of doing Roths in a SEP or Simple. And then probably after that, I'm going with just getting more guidance on the prohibited transaction. So now we know clearly that each IRA will be respected as a separate entity from a prohibited transaction standpoint. So now at least we have a game plan where we can isolate our IRA, grayish transactions and know at least it's not going to impact any other IRAs we have. What didn't make it that I wanted? So the one provision that I really thought would be in here that didn't make it was there's still an issue that if you have a Roth IRA, you can't roll it to a Roth 401k. Makes no sense, right? You can roll a Roth 401k to Apple to a Roth solo 401k. Okay. They didn't change the fact that you can't roll a Roth IRA to a Roth 401k. There's no good reason for it. The reason the rule is there is before 1997, there was no such thing as Roth IRAs. They just haven't updated the rollover rules. I thought this bill would do it, and it didn't. So that's really the only provision I really truly wanted that wasn't in there. Other than that, I think all the provisions are good. Secure Act 1.0, had a lot of good stuff, but it had some negatives too, right? It got rid of the stretch IRA. it basically forced us to take RMDs over, a 10-year period, except, if you're a minor or had a disability. Whereas prior to Secure Act 1.0, you could have stretched it out over the youngest beneficiary's life expectancy. That would allow you to keep the IRA the funds in the IRA for more years, which would allow it to grow longer without tax. Now with Secure Act 1.0, there's not a lot of provisions. Actually, I don't think there's really any provision in here that I dislike, like the stretch, the elimination of the stretch. Next week, I will do a video on key 401k contributions, kind of do some focus on solos. Most of them do apply to like safe harbor 401ks or defined benefit plans or multiple employer plans. So I'm not going to spend too much time on those, focus more on solos and some on safe harbors. But now I'll probably do a live video. It's not going to be Wednesday because I'm traveling, probably Friday next week. So watch out for that. But this is an important video because there's some monumental provisions in here that are going to impact us, like several I mentioned, right? The RMD change, the catch up, the Roth of SEPs and Simples, the 60, 61, 62, 63, even though that's not going to start to 2025, you've got to start planning for this stuff, right? And you'll see also for next week for the 401k, there's some biggies in there that we're going to want to discuss. So I'm going to get to some questions now, but this is important to understand because there's not a lot of press on it. There are some articles I read online that kind of focused on this, but they passed this during Christmas and New Year, and obviously our minds are elsewhere. So hey, that's my job, right, to educate all of you. Let's get to some question. We're moving from Gemini to Bitstamp, which is going to hopefully happen in the coming weeks, and we'll be notifying you of that. So that's exciting news as well. Other than that, I don't see any other questions that seem on topic. So I guess I'm going to end for today. But again, definitely look out for my blog, which I'll drop in our newsletter next week. And I'll just kind of cover these provisions in more detail so you can read them, you can have them. I got another question. Are we required to keep notes of minutes for self-directed IRAs? No, if you have an IRA LLC, there's no meeting requirements. Unlike a corporation that has corporate formalities, an LLC does not have corporate formalities, which is one of the advantages of an LLC. So no, you do not have any corporate formalities. Thus, you do not need minutes for IRA LLCs. You should still respect the entity as an entity owned by an IRA and managed by you, but you don't need corporate formalities. So other than that, have an amazing 2023. Wish everyone happiness, health, prosperity, and look forward to an amazing 23. And again, this is a weekly video. Try to do it every Wednesday, 12 Eastern. But for example, next week, it will be at a different date. So that's an important reason to subscribe to this channel. We drop 3 to 4 videos a week, do 3 podcasts. So if you're hungry for self-directed retirement content, this is the place. And guess what? It's free. So go for it. Some good stuff. I really take a lot of pride in what I do. And as I mentioned this, I learn a lot from you. A lot of the content and topics I chat about come from you. So if you guys have questions, let me know. You can leave chat. You can leave a comment. I do my best to get back to all comments within a day or so in a timely manner. You can email us at info@IRA Financial and just say, ask Adam or Adam Live, whatever works for you. The questions get to me. I do have a good queue of questions. If you like the Q&A format, you can check out my Ad Mail podcast. It drops every Thursday. In that podcast, I address 3 of, I think, the best questions of the week from clients, non-clients. And there's some really fun stuff in there, and it's a great way to learn from each other, right? Some good questions, and maybe you thought about it, maybe you didn't. but I promise they're topical and important. So more to come on Secure Act 2.0. Obviously, we're just still digesting it. It's a monster 400-page or so section that deals with Secure Act 2.0. But I will continue to focus on the 313, the excise tax, and the additional contribution statute limitation question. There's going to be more guidance on that, or hopefully at least more discussion, because it's still unclear what they're doing, right? They say 3 years on excise tax, but 6 years on additional contributions. What's their play? Could they use that on valuations? Is this a way to go back and attack IRAs for 6 years to argue this is a valuation, additional contribution issue? I don't know. I think so, but I'm not sure. So I think they have ulterior motives. They could have drafted that much more narrower, less broad, but they didn't. And the fact that they're dividing up excise tax and additional contribution has me worried a little bit. Yes, we do offer self-directed SEP IRAs. We have obviously the ability to do it with an LLC, without an LLC. We have solo 401ks. Now you can do pre-tax. Now you can do Roth. We do it all, and you can do alternative assets with it, control whether it's real estate or the like. And obviously, you get to work with us because we're the best at what we do. We literally wrote the book on the self-directed IRA. So, one more question. I have $7K in rent in a self-directed IRA property. Where do I put the money? Put the money back in the IRA. The IRA owns the property. Send it back to the IRA. If you have an LLC, go see the LLC bank account. That's why a lot of people like to do the IRA LLC, because they'll have more control over the process. The LLC will have its own bank account. The tenant, whoever is sending you the money, will send it to the LLC. You can even use Venmo, Zelle, ACHs. It's have more control. But yeah, if the money is owned to the self-directed IRA, it's a full service. There's no LLC. Go on our app, fill out a deposit form, send the custodian the money, so it could be deposited in your IRA. Otherwise, thank you everyone for spending some time with me today. I know there's a lot more you guys can be doing. Start on New Year's, but I do appreciate it. And again, just want to wish everyone an amazing 2023 and look forward to working with all of you guys, or at least talking to all of you in the coming year. Take care and have an amazing day.